And the last important consideration is your TTR strategy. So because of the fact that you may have planned for those of your clients age 50 and above to put in 50,000 as part of your TTR strategy and optimizing based on that higher level, then you need to consider what the impacts are now that with 25,000. And don't forget too, we did have some of the tax changes as well. So in any case, as part of your annual review, then your TTR strategy should now take into consideration and in working out the optimum sacrifice amount on the basis that is on 25,000 and not 50,000. But most importantly, just to make sure that from 1st of July onwards, that you bring all your clients down back to 25,000 just to avoid any potential problem. And certainly if there are one-off bonuses that have been in normal circumstances been put into super, then just make sure that those bonuses, if it's going to go into super from 1st of July onwards, will be within that $25,000 limit. Don't forget SG is included in there as well too. Now, the only other one which obviously you've been reading a lot in the papers about is the reduction of the contributions concession for high income earners. All right, and basically what it's saying is that for high income earners, and which we define in, as you can see on the slide there, is that the contributions tax applying on them would be, as a result of reducing the concession for them, is to increase from 15% to 30% the contributions tax, pretty much like the surcharge, isn't it, back in those days. The only thing that you need to be looking at is really high income earners, what the definitions are. Do you have any of these high income earners anyway in your client portfolio? But basically high income earners are defined as ones with income, so it didn't really get into the definition of what income is. So at this point in time, without the legislation, is income greater than 300,000. But what we do know is that income is defined to include concessional contributions. So for example, if you have a client who earns $280,000 and had a $25,000 concessional contributions, for this purpose the income is $305,000 if I can add. 280 plus 25,000 is 305,000. So for this purpose then they will be termed high income earners, and then contribution tax would apply at a higher rate of 30% to these individuals. Now, a small point here, well, it's not a small point, but the way it operates is it only applies, 30%, it only applies to any contributions in excess of the threshold. So in my example, for instance, we have someone 280,000 taxable income, so I'm not even going to refer to taxable income because I don't really know what incomes really means. So if his income is 280,000, then we have a $25,000 of concessional contributions. For this purpose, it's over 300,000, 305 in my example. Then we've got to think about the 30% tax on contributions. Now, in this case, we have 25,000. The 20 is added to the 280, makes it 300. The 5,000 is in excess of 300. That means 5,000 of the concessional contribution will be taxed at 30%, but not the 20,000, which is included in the $300,000 limit there. So of the 25,000, 20 would be at 15%, 5,000 would be at the 30% tax rate. Talking about trying to make it complex, we could have just easily made that everything taxed at 30%. But just be aware that it's only on contributions tax and only for high income earners. So what do we need to do with your clients who are high income earners? So let's have a look at the strategic considerations and impacts. Obviously, we need to consider if your clients are high income earners, or they could be bordering becoming high income earners. We need to look at sort of managing the income, especially once we do know exactly what income means, but just for this purpose, just ordinary income for the time being. Then looks like for some of these individuals, then they may have tax effective structures involved, companies, trusts and what have you. So it might look like it's a return of these tax effective structures to try to contain the income and the concessional contributions to below that $300,000 mark. So it's something which you perhaps could consider, and it might be one which you need to work with their accountants as well too. I think another important consideration is the limited recourse borrowings. This is obviously stopping the contributions going in at a concessional tax rate. In a way, that may not be that important anyway, but it does again bring into the spotlight, I guess, the limited recourse borrowings, which does provide some concessions to be able to have the earnings, capital gains within self-managed situation, and therefore I think that will become an important strategy to consider, given that we've lost some of the concession here for some of these clients here. Now, another point that you just need to be aware of is that if your clients are unfortunate enough, they've gone through to the excess concessional contributions, glad to report that this additional 15% doesn't apply to these excess concessional contributions for the fact that they're going to be taxed anyway at the top tax rate, so no 15% on top of that. So the maximum amount is the top tax rate on the concessional contributions. Now, a couple of other interesting super measures that you may want to be aware of. CGT and loss relief for mergers of funds. We've had these sort of provisions previously, and that's allowing funds to merge or to roll over into another fund, and that's really providing incentives for them to do so without losing or crystallizing capital gains or losing their losses. So it is sort of a comeback, and the government is proposing to allow these provisions to apply from 1st of June 2012 till 1st of July 2017. So for some of your clients where the funds needs to be merged, then the loss relief and the rollover reliefs will be available from 1st of June onwards. Another area, self-managed. The government felt that there should be a strengthening in this area as far as auditors' registration is concerned. So auditors, self-managed super funds auditors will need to register commencing on 31st of January 2013. Very funny date, 31st of January, but I guess it is a date for accountants. So from 31st January 2011 onwards, they have to be registered as MSF auditors. And there's also a requirement that they will have to pass a competency exam, and that will be developed by ESIC. And ATO, as per normal, is been told to monitor and ensure the compliance with these competency standards and monitoring the auditors. Now, what to look out for, I guess, and the considerations. In terms of your clients, if they're rationalization for fund mergers and transfers, then be aware of this loss relief that's available. Pretty much the registration is a good thing. It sets a minimum standard for auditors and provides some comfort to the industry and stakeholders in self-managed. So I think it's all good change in strengthening the position there. Okay, we're nearly there. The last section of this part of the seminar, if you like. Social Security and aged care. There's some changes in this area, so we'll have a look at what may impact you and your clients. Firstly, again, you've read about this all in the papers, but it's good to recap. School kids bonuses. It is a replacement for the education tax refund, a tax refund. Very few people would have claimed in the last couple of years. So as a transitional arrangement, it's replacing it pretty much immediately, and it's replacing with a one-off lump sum bonus payable to eligible families in June, which is next month. So it's replacing the ETR immediately and by a lump sum paid next month. But going forward, then the bonuses will be made a couple of times a year, January and July each year, commencing from January of next year. And you'll probably be aware that it's a per annum payment for each primary school student, 4 and 10. For secondary school, just doubling that, 820. What is good about this bonus claim is, unlike the ETR